Welcome to today's Marketplace. I'm Jane King, and today we are joined by Dr. Tirimba Obonyo, Associate Professor of Economics and Finance at Creighton University's Heider College of Business, and Mark Henkels, Managing Director at Moelis and Company. Good afternoon to both of you. So now the Price Waterhouse mid-year Outlook report showed that volumes globally of mergers and acquisitions have dropped in the first half of this year by 9%. There are still a lot of M&A deals getting done, but changing market dynamics are presenting some hard choices for some companies. So, Dr. Obonyo, what are some of those market influences that are impacting the M&A movement?
Yeah, I think going into 2025, we've seen a number of uncertainties that seem to be, clogging the market quite a bit. So, for example, big news has been on the tariffs, for example. So everyone's been talking about those. Everyone's waiting to see what's going to happen on those. So before you commit such a tremendous amount of capital, you kind of want to make sure that you're buying the right business and it makes sense for this. So we are waiting to see some of that unfolds. You've also got interest rates being fairly high, so capital is quite expensive, so everyone's being a little bit careful. So those are some of the big factors that I see sort of holding up the market a little bit at the moment.
And then just cover some of the basics. How can M&A activity impact the valuation of companies?
Yeah, so when you think of an M&A and one company trying to buy another one, I usually think of three things. One is you want to make sure you have the right target, and then two is you want to get the right price, and then three, you're worrying about the the integration that comes afterwards. So at the moment, with all the uncertainties around tariffs and interest rates, and also artificial intelligence and how companies are deploying that, everyone's still trying to find their footing around some of these, and so pricing companies is a little bit difficult when you have uncertainties, for sure. So getting the right price when you're trying to get a deal, even if you've got the right company, still kind of remains to be seen. So some of those uncertainties still become a big driver of one of the really important pieces of an M&A transaction.
Yeah. And Mark, turning to you, so amid these complex market trends that we're seeing, how do strategic experts like Moelis and Company see through all this turbulence? How do you kind of understand what shareholders want and determine a value in that environment?
Well, thank you for inviting me, Jane. Well, at Moelis and Company, just to provide some context, so we're a relatively young firm. We're 18 years old. We started with an idea, which was to provide strategic, unconflicted global advice. And today we're 1,300 employees, we're in 23 offices, and we're global. And so in the corporate boardroom, we provide that kind of unconflicted advice to a situation. And picking up on Doctor's overall observation about deal volume being down, I would make the comment that values are up considerably, 20% in fact. So while volumes are down 20 to 30%, depending on the US or global, values are up. So what is going on? And what is going on is larger transactions. $5 and $10 billion transactions are up considerably, and in particular at the corporate level. So what is happening in an environment that you've outlined, which is relatively uncertain, there's been a pickup in larger optimization within the portfolio of strategics or transformational transactions, which are guiding corporate direction, and I think will be very much the trend in the future.
Now, would you say that shareholders aren't as impressed as they used to be with investment capital?
Well, I would say that historically, going back many years, 20, 30 years, there was an emphasis on growth, perhaps at the expense of cash flow generation. I, in particular, cover industrial companies. And what we have seen in the boardrooms has been a re-emphasis on free cash flow generation. So strategically, if there is a target and the pro forma results of that target are interesting, the next step in the decision is, what does this do pro forma for the overall company? Can we get re-rated? And typically, what we are finding at the board level is higher free cash flow generation correlates to higher trading multiples for those public companies. So often it's not just the target at hand, but the pro forma result on the whole company. Why that's important is because if the valuation multiple does go up, it's not just for that acquisition, it's across the whole company. And so the value creation potential can be incremental above and beyond the acquisition at hand.
And Dr. Obonyo mentioned interest rates. How are corporate executives dealing with the higher interest rate environment that we're seeing right now?
Well, it's interesting. The transformational transactions, the optimizations and portfolio repositioning, those conversations are live and active. In a higher interest rate environment, generally hurdle rates are larger, and so the one-off acquisition, the pro forma impacts will bring down the valuation because the hurdle rates are less attractive, right? So in a buyer-seller dynamic, that tends to slow down the activity. There's a buyer-seller valuation gap that needs to be bridged. And so there are more creative avenues to structure transactions instead of just, for example, cash only. And so we're seeing that trend accelerate as well. And so I would say because our DNA is based and has been, over half of our transactions are with financial sponsors. I would say that perhaps in comparison to strategic, sponsors are even more sensitive to that seller-buyer valuation gap and have slowed down. So realizations in private equity have slowed. And I think that is a function of some of the uncertainties the doctor outlined earlier and higher interest rates that are bringing that valuation gap much more into focus.
Well, in like the 90s and 2000s, we heard a lot about growth. Like a lot of these mergers were done for growth. Has that changed? And if so, what are people looking, what is driving these mergers now?
Well, growth will always be a part of that element. I think simplification, let the investor decide on diversification. And so I think there's a balance of growth for only sake, but there's a durability, certainly on the industrials, to create value through cycle. So through cycle is a consistent theme that we hear in boardrooms on the industrial in the industrial complex. And so growth, sure, but growth through the cycle with all the levels of uncertainty is really paramount. And that, again, impacts the valuation discussion, depending on what point of the cycle we happen to be in the current month.
Now, Dr. Obonyo, I would expect international M&A deals to be most susceptible to vulnerabilities. Is that true? And if so, why do you think that is?
One of the things that I would say coming out of the pandemic was there's been a heightened sensitivity to sort of supply chain risk, where we're getting materials from and how strong are our links to our sources of material and the likes. And so given that, and then the backdrop of the tariffs and still some geopolitical concerns to shake out, it necessarily means that everyone's being quite careful with trying to go cross border. So in some cases, I would say some of the risks that we have seen are geopolitical risk to it. So some of those are a little bit more emphasized when you're looking cross-border, trying to buy a company abroad. And so that's playing out quite a bit in my viewpoint.
And Mark, when it comes to acquisition strategy and negotiations, does Moelis and company bring the research-based expertise into the negotiation for your clients?
Well, that's a function of, we have close to 1,000 bankers, 940, 1,300 employees. They each have sector expertise in some level, or a product expertise. We emphasize M&A advice, capital structure advice, and private placements of capital and so forth. And the amount of analysis that we do, we're not a consulting firm, but we do dig deep in each individual sector with our teams. We have lean teams, and we collaborate. If there's one theme with, at least at Moelis, is that we were, again, a relatively young firm. We had a clean piece of paper. We started from scratch. We wanted to build a firm durable through the vagaries of the capital market cycle and so forth. And we established, and one part of Ken's genius was one income statement for the firm. And that's very unique on the street. And so that promotes collaboration. If our clients need expertise analysis coming out of Germany, that client gets it, right? There's no discussion about whose deal it is and so forth. And so structurally, unlike perhaps anybody else on the street, we have put in a collaborative framework that the proper analysis and the proper strategic advisor is in front of that client.
Okay, and let's talk about AI and how it's impacted, it seems like everything. So, Dr. Obonyo, has AI impacted the information that we've gotten, the flow of information, how investors track the market?
Definitely AI is a big piece of everything that's going on in the marketplace right now. And we're increasingly seeing companies committing capital towards investments in AI, and for good reason at this point in time. If you don't, you're probably being left behind. Where I see AI has sort of come in and plays a really big part in this industry is in terms of processing the volume of information that investors are coming across on a day-to-day basis. We've got the traditional sources of data that we rely on, the financial statements and the likes that you get from a company, but increasingly investors are relying on different sources of information from a whole range of sources. So the AI's ability to digest such volumes of information and give us something coherent in a very short window of time confers quite an important advantage to investors and others in this space. Just the other day, I was watching a clip in this is more of like AI and education, and there was a segment in one of the Sunday shows in the morning that talked about how it affects sort of like my job, because we're looking at how do we train students and how do we assess their learning and things like that. And in many ways, I believe AI is going to be incorporated in the process as opposed to sort of being outside the process, because it's going to enhance the skill sets rather than necessarily prevent students from getting the skill sets in the first place.
Okay, interesting. And Mark, how do you see AI? Has that helped, hurt, both your industry?
I would say it's somewhat embryonic. It's early stages. It is a topic in every boardroom from a corporate standpoint, how to take advantage. I think from a Moelis standpoint, certainly we are beginning to use AI to accelerate the processing of vast amounts of information and predictive information to help strategic thinking. And again, we're built to provide independent advice. And the more information that we can use in that calculus, the better. So I would anticipate a great acceleration of AI. Right now, we're early stages. It's, but in the corporate world, we're seeing it much more on inventory management, predictive maintenance, those types of items. I expect that to greatly accelerate.
Okay.
And I would add, in terms of, I also feel as though it's playing a part in the M&A deals, because you're not really ready to deploy tremendous amounts of capital buying a company whose AI prospects you're not exactly sure. So given this is still in an embryonic stage, there's still some learning to happen and some distance to go. And perhaps in some cases, everyone's keeping their powder dry until some of that unfolds a little bit more.
Okay. Very interesting. Thank you so much, Dr. Mark, for joining us.
Thank you,
Very
Jane.
insightful.
Yeah, thank you for having me.